Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of today's video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick things off here on the SPY daily time frame chart, then we'll jump on over to the sectors and other intermarket components. What do we see from a price action and structural perspective? Certainly some cause for concern on today's session. Notice that we close extremely weak at the lows of today's trading range, and we've also violated 378.50, which is much more important. Why is it so important? Because it was a prior daily area of resistance, then offering support, and most importantly, it was the high of Friday's hammer buy setup, and we've also got an intraday pullback that perfectly respects it on Tuesday's session. Buyers respond in a strong enough fashion that this bar actually closes green up and over the opening print. So things were looking pretty solid from the buyers, and here it is on the hourly time frame chart. There's the breakout level, there's the break, perfect defend of the level, there's the open, notice that the close is above, and even look at the 2 intraday hourly candles that formed early on in today's session. Each of them have lower wicks that pierce underneath 378.50, but notice that neither of them close underneath, so buyers were trying to defend early on that level. Unfortunately, it's not enough into the close and the sellers run away with it. What's the point of walking through this exercise of looking at the price action through the lens of a microscope? It's because this clearly identifies a shift in tone from the bulls being in control, supporting at a very nuanced level, buyers looked good, to all of a sudden the sellers running away with it. This is a clear shift in tone, and now we have to be open to bearish possibilities. We were quite bullish early on in the week, but now things have changed. So how are we going to get involved on the downside is the next question. There's a range. Obviously, 378.50 is the upside, and the bottom is 371.25. If we're stuck in between this area, it's exactly that. It's chop. I would not be married to direction. If, however, we break down underneath 371.25, the door is wide open, let me repeat, wide open, for the sellers to bring it into the lower edge of the weekly expected move and prior confluence of support from structure here at 364.60. Why do I emphasize that the door is wide open as opposed to shut or even locked and the sellers have to pick the lock and carefully open the door? Well, it's because the daily trend is in jeopardy. Right? It's in jeopardy of changing in the bear's direction. The current trend count goes something like this: low, higher low, higher low. We've got highs, we've got higher highs, higher highs. So the daily trend is currently up, but consider that now we've got highs, lower high. At best, the trend will be neutral when and if we tag 371.25. At best, you could call it neutral. And if we crack underneath it, now all of a sudden we've got low and lower low. So you can clearly see that that would confirm a daily downtrend. Bears can rejoice and we'll look for downside targets. And here on the channel, we will certainly shift our tone underneath 371.25. We always change when market conditions change. 371.25 is still the level. Why else is that number important? Not only because it will produce a new lower low, but it's also still the top of the original balance area here on the daily time frame chart. So if we cross underneath it, it would certainly be reasonable that we could head back down towards the lows of that balance range at 356.75. Right? From a measured move perspective, that's where you go. What about a pattern perspective? If you do something like this and talk about head and shoulders, break of the neckline right around that 371.25 also initiates a bearish sequence. And what's the measured move on a head and shoulders? Typically, you go from the head to the neckline and you stack that at the breakdown point. So just based on a quick eyeball test, that seems about reasonable to me. Notice that it's underneath 356.75. Another bearish outcome. So I'm not arguing that this breakdown all happens over the course of one day. I'm not saying that it happens all over the course of 2 days even. But what I am saying is that as and if prices cross underneath 371.25, we will be in a daily downtrend and we will be open to the possibility for downward continuation, right? That's how you play a downtrend. You are looking for moves in the downward direction by nature. So we will change our tone when it is right to do so, and 371.25 is that gatekeeper of a level. Now you might be saying, okay, then if it crosses up and over 378.50, you must be bullish again. And I would say, hold up. Not so fast. The buyers already had their opportunity. Intraday, they proved themselves on Tuesday. It's all gone out the window. So now from a trend perspective, in order to stay in an uptrend, we've got to put in an equal high up around 389.50. So to get there, There's a lot of work to be done, especially considering the breakdown from today's session. I don't necessarily think it's all in the cards for that to happen into the end of the week. Now, what of course is the complicating factor here? 8:30 tomorrow morning, CPI print will be coming out. That's Consumer Price Index. That's the inflation report. We'll be live at 8:15 to see the market's reaction. And we'll also give you a follow-up video tomorrow afternoon, hopefully not so late this time around, to see how the dust ultimately settles. Okay. With that being said, let's continue along through the analysis. If you've been enjoying the slower paced late night video, let me know in the comments, give the video a thumbs up. Here's the internal screen, top right hand corner's got you covered with a tutorial if you don't know what it is or how to set it up, and we'll get right down to business. In the volume reads, notice that we've got significant outflows on today's session, well underneath negative 300 million. That does strike me as a very bearish data point. Now, the counter argument here might be, isn't this just, de-risking ahead of CPI? And it certainly could be to some degree, but a more mild de-risking look would be something that does this and maybe simmers out around negative 200 million. The fact that this was so extended underneath negative 300 million does strike me as, again, really significant outflows from the market, definitely a bearish data point. In the advanced decline line, remember what we talked about on the hourly time frame chart of the SPY, that the buyers initially tried to respond and hold that level. Under the hood, we produced a lower high here, which is technically bearish, right? And where do we close? Underneath negative 1500 in trend zone lower. That strikes me as a bearish data point here in the advanced decline line as well. Tick cumulative read, of course, is bearish, so I'm not seeing any major divergences under the hood that would question any of the sell side activity we saw on today's session. Does strike me as legitimate and strong. Let's take a look at the market profile. We'll keep it simple here. Again, if you don't know what it is, top right-hand corner's got you covered with a brief tutorial. The main focus of the market profile currently was the double distribution from Monday. There's the upper and there is the lower. Bulls, of course, wanted to see further price action above the upper distribution, and it was, again, looking quite solid on the Tuesday session. Point of control was above. We had a poor high that could possibly use some repair and get a breakout. It simply didn't unfold. What happened on today's session? Well, we certainly closed underneath the bottom portion of the lower distribution, and in the post market, which is this gray blob right here, we're getting price acceptance underneath the lower edge as well, which does strike me as bearish. So market profile would stack up in the bear category. Here's a quick preview of the CPI. If you're not going to tune in live tomorrow morning, then at least just consider this. Remember, it's at 8:30. We're going to get CPI month over month, year over year, and the core month over month. The main thing you want to focus on are these two numbers right here. Does the market beat them? And by beat with a CPI, we want to see numbers that are underneath these two areas here. Or does the market come in hot above these two numbers? If we come in hot, then guess what? Jerome Powell is very likely going to give us that 75 basis point rate hike come the next meeting in December from the FOMC. As of right now, the current pricing in is for 50 basis points, but if inflation's still hot, Jerome Powell will keep rates higher for longer as he's committed to do so, and that will, of course, not sit very well with the market in my estimation. What is slightly concerning about this, without even seeing what the reads are yet, is that the month over month is forecasted to be bigger than what we saw in the prior month. That is not a step in the right direction. We need to see inflation coming down. Ideally, these prints in this box right here start to become negative. I don't think that we're anywhere near that from an economic perspective, but that's what the market would like to see. That would be a huge sign that inflation is certainly settling down. In terms of the year over year, we're a step in the right direction, 7.9 versus 8.2. But again, think about what happens if this misses. If this is above 7.9, if it's on par with 8.2, ugly, ugly, ugly. Jerome Powell is likely again going to give us the 75 basis point rate hike, which the market would not digest very well in my estimation. Of course, all of that is subject to change, which is why we'll be covering it live at 8:15 tomorrow morning. I would encourage you to be there. If not, watch the follow-up video tomorrow after the close to see how the dust has ultimately settled. Let's get back on over to the platform and round out the S&P with our sectors and interesting charts. What do we see here from a sector perspective? Who was leading? Who was losing? Where was the weight? At the top of the pack, we see the energy sector, which was actually down the most, down 3.58%. The utilities at the bottom of the barrel down the least, down 0.38%. Not really all that concerning to see a distribution like this with defensive sectors on either end when everything throughout the entire course of the day was red. The heavyweight sectors will mean a whole lot more. So the XLK, the tech sector, the heaviest of them all, was red, 1.69% on the downside. Financials down 1.02%, XLV Healthcare down 0.92%. So overall, it does stack up and add up. Yes, it makes sense. We did see a red day here in the marketplace, not seeing a whole big divergence from a distribution perspective. Let's check in on the structural charts and see how the trends are continuing to develop here. In the XLE, ideally we break down underneath here and come in for the back test of the original breakout point at 84. That probably sits better with the market, and of course, in the meantime, downward pressure is still downward pressure for the S&Ps, but we don't want energy hanging out up here towards the highs, right? This is not a bullish look for the market. So if you're a bear and you want to see the S&P crash and burn, look for this to stay in the range. If you're a bull and you're trying to find a reversal here, you want to see this come lower. Again, in the short term, downward pressure is still downward pressure for the S&P, but that's the structure you want to watch. Let's speed it up a little bit through some of the sectors. I know the video is already late. Here's the XLY. Let's keep it very simple. 135 is your number. Lower highs underneath continue to be bearish outcomes. The only time that we're even considering a look below and fail is if we can put in a higher low above 135. So 135 is the number. What side of it is ultimately the question to be answering here. Anything can, again, happen with CPI, so we'll follow up in tomorrow's video as to whether or not that's a look below and fail. Let's take a look at the XLK, the tech sector. This is a little bit more neutral, just in the midpoint of this overall range. I would certainly carry forward more of a bearish stance, noting that, yes, the weekly trend is certainly down. We've got the failure on Tuesday, just like in the S&P, so slight bearish edge here, but really the breakdowns will start stemming from underneath 119.75. Remember that this will be especially sensitive to the CPI print tomorrow morning. Here's the XLB. Unfortunately, this chart looks fantastic. It produced a new higher high, and it's just now starting to pull back. Ideally, a higher low is produced at 75, and it continues its daily uptrend here. Unfortunately, again, it's just such a lightweight sector. It's not going to make or break the S&P 500. Next up, we've got the XLF. What's going on in financials? Everybody's calling this a double top, and it certainly could become a double top, but hold your horses until we break down underneath the neckline. That's how the pattern works. We've got equal highs in an overall uptrend. There's no reason to be bearish yet until we start making that lower low. That's exactly what we just discussed in the S&Ps, right? But the S&P already has a lower high. So overall, anything that stays in this box, anything that's above 33.25 is ultimately neutral for the S&P 500, and I would call this a weekly bull flag. So only getting bearish if we violate and close underneath 33.25 in financials. Anything else is just noise. Don't get me wrong. If we make it there in the first place on the intraday, of course, that's bearish pressure for the S&Ps, but I would not carry forward a long-term bearish stance until this level breaks right here. Next up, we've got the XLC for communications. What's going on in comms? Certainly a much more bearish chart. We're not even going to get too far into it, but underneath 48 by a significant margin, especially through a thin structure candle like this. Big failure from the buyers to even get close on the true backtest of 48. Looks more likely that we rotate under 46 and see continued breakdown, bearish for the S&P. XLV, the healthcare sector. Very similar to the financial sector, you've got your possible double top, but it's not a double top until it is, which is underneath 129. Until proven otherwise, we're neutral in this area, noting that we've already experienced the look below and fail, and we hit the target, which is always the top of the range, or the opposing end of balance. So that trade is over. It's neutral. In this box, there's nothing to do. Continued breakouts over 133.50 support a bullish marketplace, and it's only bearish for the double top under 129. Based on today's session and where we're at from a location perspective, I would have to stay neutral in the XLV into the remainder of the week until proven otherwise. Again, 129. The reason that I want to harp on this one is because it's the second heaviest weighted sector by market cap. XLP for consumer staples. What's going on over here? What was looking like a beautiful pressure cooker top at these highs has unfortunately resulted in a flush point. Now we've got three equal lows at 72 with the failure in that upper wick with an overall bearish stance or feeling in the market. I would sort of favor breakdowns of the three equal lows to rotate to here. Again, if you want to call it a double top, that's fine, but just be patient for the breakdown of 70.85. This chart does look more bearish than something like the XLV that we were just on. Next up, we've got the real estate sector, lightweight sector, still continuing to monitor this inverted head and shoulders. Remember that the macro narrative of the economy doesn't really support a big breakout or a housing boom right now with rising interest rates, but just monitor and keep a close eye on 37. If it does break out, there might be a scalp there. It's at the end of the day a really lightweight sector, so it's not going to make or break the S&P. Anything that continues to chop around in here is fine, only concerned with big new lower lows underneath 34. Industrials, really big part of the market rally here. You can see that this chart probably looks looks the strongest of everything we've seen barring energy, which is hanging out towards the highs. Look at the structure, right? We're still above the flag breakout from earlier on Monday, only pulling back into that level on today's session. So ideally, this stays above 95.35 for bullish outcomes. If we're looking for bearish breakdowns of that SPY 371.25, watch for industrials to break down underneath and rotate to 92.50. All right, that would certainly help a breakdown in the S&Ps, considering that industrials have been such a strong component of the rally that we've seen so far. So 95.35 is your level to watch. Last but not least, we've got utilities. What's going on in Utes? Going sideways in what was starting to look more like a flag, but with this sort of descending resistance trend line, inverted hammer on today's session, looks like it may want to continue lower. Remember that this is fine. Utilities going sideways down here is exactly what the market wants to see if we're trying to find more of a firm bottom. Again, this doesn't guarantee the S&P 500 moves higher, but so far, this chart doesn't really strike me as a concern from a risk-on, risk-off perspective. Speaking of which, let's get on over to the ratio grid here. If you don't know what the ratio grid is, top right-hand corner shows you how to set it up. The top four are the risk-on sectors. Let's keep it very brief. They're all diverging. XLK is bearish, XLY is bearish, XLV is bullish, XLF is bullish. You're not going to really have a clean risk-on environment when all of these things are divergent. Ideally, XLK is the one that starts to perk up here to sort of sync up with financials and healthcare for a better look. XLY can be the laggard. It's the lighter of the heavy four sectors. The bottom four are the risk-off sectors. Notice that XLP looks great on the breakout here, technically over this flat top. This is, of course, a risk-off look for the marketplace, not really that bullish. Energy is coming in slightly, but still in a massive uptrend. Utilities, a little bit of like an inverted or cup and handle-ish look, which would, of course, indicate a move higher here, which would not be great for your S&P 500. And real estate is also just kind of like sideways down here. I wouldn't read into the real estate sector too much from a risk-on, risk-off perspective. Let's take a look at the XLY over the XLP and see what we've got from here. Notice that we've got a new low. All right, new low in this ratio. Remember that the market likes to rally as this is rallying. This entire time that we've moved higher, I've continued to say this is actually a bearish data point for the market. People are not favoring growth, they're favoring value. And as of right now, on the new lower low underneath here, I would certainly read into that as much more of a bearish data point supporting the bearish narrative that we've been talking about so far in today's video. Let's take a look at the dollar. Dollar is up next, and you can currently see that we're trading at the support trend line, but we have not firmly broke down underneath it. So this can continue to compress in range and fire off to the upside. That's certainly still well within the realm of possibility, but I would start to watch just the horizontal level right here around roughly 109.50. If that moves underneath, that's bullish for equities and counter to the argument that we've been making so far. If the dollar rallies back to the trend line, probably hurts equities into the remainder of the week, and 371.25 breaks down. Let's take a look now at the TNX for our 10-year interest rate. What I find really surprising about this is that rates are honestly going sideways. It could be in anticipation of the CPI print tomorrow. If CPI comes in hot, expect these to move higher. One thing that you can take a look at is the TLT, which is, of course, the 20-year bond, right? Zooming in on this. All I would point out from this perspective is that we're already underneath that sort of balance range that we had been discussing in the past. If we zoom in on the S&P and look for like an equivalent area, right? This is signaling some divergence. We're looking for lower here. These things tend to move in sync. Now, it doesn't mean that they can't, ever move out of sync, but this, of course, would be a bearish divergence looking for the S&P to move lower. The next one I would want to show you is the HYG high yield, right? And in looking at this, notice how divergences in the past almost always, let's go to, where are we? We want, it looks like maybe that drawing set got deleted. However, every single time there's been a divergence, I don't want to say every single time, but most times there's a divergence. I'll just sort of highlight them like this, since the drawings must have been deleted. Notice that the HYG leads the S&P 500. I don't want to get too granular with some of these over here, but you get the gist, right? High, lower high, S&P made high, higher high, S&P follows by moving lower, right? So the divergence plays out. Notice in the bottom that you get the first high or low signal here. This is an equal low, and then we rotate higher in the S&P. I'm not going to talk about all of them, but the most recent divergence in play, if you look towards the right side of the screen, is that the HYG made a new lower low underneath here. The S&P 500 did not. All right, so from a divergence perspective, it would look like the S&P wants to head lower and follow, quote-unquote, smart money up here at the top in the HYG. Just something to consider. The next one is the unemployment rate. We don't often look at this one. We brought it up once in the past before. But what I would want you to realize is that every single time, most times I should say, that there's an uptick in unemployment, usually it accelerates very rapidly. There's very rarely an uptick in unemployment that doesn't accelerate rapidly, right? Accelerate rapidly. You can see these descents take their time. The descents take their time. Every time it's an uptick, we really significantly move in the upward direction. And I figured that this was something relevant to bring up to you, considering the Meta announcement today with 11,000 employees being laid off. Can you imagine what the next unemployment read is going to come in as? I would certainly imagine higher than what it is today, indicating the start potentially of a ramp higher. Every time employment ramps higher, that usually leads to a bit more pain in the stock market. Just something to consider, again, relevant based on the Meta announcement today. Let's take a look at volatility products. Here's the VIX. What do we see in the VIX? Certainly a little bit of an up move in the VIX after, what was it, like 16 consecutive down days here. So overall, still not out of the woods from a volatility perspective. Volatility is still well elevated over 2050. And all I would just continue to point out is the mirrored situation to what we have over in the 2008 situation. So again, bear with me. This is a late night video. Hopefully you're relaxing and you've got some time on your hands to sort of unfold and watch these things in full. But there we go. There's your '08 situation. Notice that we're getting pure price acceptance, not really price in the VIX, but acceptance over 2050. We're just watching to see, if we can't get underneath 2050 with any conviction, a capitulation type bottom very well could be on the table if that unemployment rate starts spiking, if the HYG continues to signal the proper divergence and we should be moving lower in the S&P, right? You can make the argument that underneath SPY 371.25, we may very well be in store for like a waterfall type event where the SPY starts crashing ultimately, and the VIX gives you that capitulation bottom up and over the 40 handle in the read there. Now, in the past, we've been saying that people have been content with the bottom from the look of the VVIX, and what I would point out to you here, very important, is that the VVIX did start to rise. So people are, and this is like most importantly money managers, hedge fund managers, are starting to buy SPY puts and VIX calls, and we're seeing that reflected in the VVIX. So all right, all of a sudden, this bottom is being brought into question as we're coming into the CPI announcement. Again, it doesn't mean that the world has to crash and burn, but money managers are starting to see the risk and defending themselves from that risk with an uptick here in the VVIX. The last thing I'll bring up is instead of looking at contango in the trade tab, what I've done is I've just subtracted the two symbols from one another. And if this is positive, it means that we're in inversion, backwardation. And if we're negative here, we're in a contango, which is what you want to see. You want to be underneath here. Okay. Now the historic reads are going to be slightly messed up because this wasn't the high volume contract as we were trading, in the past. But ultimately, what I want to point out here is that, if this pops back up and over the zero line, we're in like a razor thin contango. We're right on the borderline of there being more risk in the future than there is there's more risk in the present day than there is in the future. Razor thin margins. We've got, what is that? 0.12. In terms of margin, and you can clearly see that's not a whole lot to play around with. As we were in a deep backwardation through this entire descent here, as the market was really, really afraid of what was going to take place, look at what unfolds in that sort of, comparison, the spread between the two. That could easily start unfolding again if we start to move towards the bottom of that balance underneath SPY 371.25. Okay, so keep an eye on this. As of right now, I just wanted to bring it up. Very, very thin margin left in the contango that we're in. So that is the volatility products. Let's now get back on over to the QQQ. Let's do a speed round through the remaining of the market. I know it's late here. So QQQ underneath the bottom end of the original balance, lower high, very obvious on the daily time frame chart. Obviously much more of a downtrend here on the daily time frame. So looking for continuation in the downward direction. Remember that this will be especially sensitive to rates. The same psychology will apply with the Friday hammer high, the defend of the Tuesday low, 266.50. As long as we're underneath that, bears are more content. Looking for the equal low at 260, and then a breakdown of that obviously brings into question the CPI gap down low at 255.25. If you're looking for bearish outcomes, this is where the relative weakness is. I would probably focus on the QQQ. If it's going to be bullish, it's got to be some sort of rotation up towards like 272, right? It's got to be some sort of higher high up and over the lower high that we currently have on the daily time frame chart, and I'm just not seeing it based on what unfolded underneath 266.50. IWM Russell 2000, the small caps. What's going on over here? Certainly your lower high. This chart is starting to become slightly concerning. Remember that it's been leading the way and it did not hold 177. That does strike me as a cause for concern, especially after multiple lower wicks indicating, hey, we've got buyers here, we've got buyers here, we've got buyers here on today's session. All of a sudden, those buyers have gone away. So overall, not liking the look of the IWM underneath 177. This would strike me as a bearish look back down inside of the original balance off of a lower high. If this is going to tell us anything about the S&Ps, it's probably, hey, don't carry forward so much of a bullish slant anymore in the S&P 500, right? All right, that's going to do it for the broad market. Other than actually, let's do our side-by-side comparison just so you can get a sense for where we're at. These are weekly charts. Remember that the white line is always what you want to focus on. IWM has been the leader, so let's start on the right-hand side. It's back down underneath its white line. The SPY is putting in an upper wick just underneath its white line. That's bearish, right? If this is going to act as a leader, this makes sense. And the QQQ never even got close to its white line, continuing to illustrate that there's relative weakness in tech. All right, that's going to do it for the broad market. Let's quickly breeze through some of these core list of companies, and then, of course, we'll dive into the three trade ideas. Apple's up first on the chopping block. What do we see here? Big equal lows after a dead cat bounce. I would watch out for lower inside of Apple. The chart just does not look bullish whatsoever. The dead cat bounce was very short-lived. It was on a gap up, and even then, it wasn't all that impressive of a close. And now we're right back down at the lows of this, area in here. So short proximity of time retest underneath 134.85 gets real ugly down towards 130, possibly on tomorrow's session. Again, CPI can throw a wrench in any of this analysis here, but looking at the charts objectively, fairly bearish in Apple. Same thing in Netflix. Round trip, dead cat bounce rejects right off of the low edge of the original balance. Bearish, right? At first, hammer candle, yes, off of 250, but the dead cat bounce so short-lived, rejecting the 200 SMA. In here, just look for a bear flag to build out, honestly, and a breakdown into 234.50 would be the favored outlook. I wouldn't really be bullish in this until we get a higher low above 265.25 at this point in time. Tesla, another real bearish chart. We talked about this in the pre-market update this morning. We never got the break or firm close above on a 5-minute chart of the prior day's high. There was no retest of here. Don't be short at this stage in the game, right? Don't be short at this stage in the game. I know it looks attractive. I know it looks like it's going to fall off of a cliff and go to zero. Just be mindful of your risk reward. You don't want to be short in the hole. We call this short in the hole. Instead, lower highs are certainly attractive underneath 187, ideally on an hourly chart. Here it is, zooming in. Lower highs underneath 181.50, even better. Okay, so wait for some sort of rally, short into the lower high. That way you have tight risk reward. Your downside target is 163. All right, if you are really looking for a long, I would say it's patience until we can get a higher low above both of those levels we just discussed. 187 is the sort of level line in the sand. All right, next up, Google. What's going on in Google? Taking a quick peek over here, lower high just strikes me as bearish, right? We're looking for that rollover. This is in the XLC, 3-day low breakdown point at 86.75. Doors open for the equal low here. Just trend continuation in the downward direction. We've got high, lower high, lower high, possibly bear flag, right? Doesn't look great. Next up, we've got Meta. What's going on in the metaverse? Big gap up. Of course, all the news about the sort of layoffs is bullish, immediately improving the bottom line for the company. However, look at what unfolded on today's session. Big gap up. We look into the overhead gap from earnings. No price acceptance. Absolutely none. Look at the upper wick. We close weak back down inside of the range from that gap down day, and now the look would be for short underneath the inverted hammer low to close the gap underneath. Meta continues to the downside. I would only be bullish if we can start to prove with higher lows and daily closes above. Remember, this gap is so large, you don't have to be the first one in the door. You can be patient and wait for an uptrend to start developing before you start longing into this overhead gap. As of right now, the inverted hammer, the lack of acceptance overhead would strike me as bearish. Next up, we've got NVIDIA. What's going on in NVIDIA? It was the most bullish chart on the table, but unfortunately, a lot of that bullish look has gone away with the close back down underneath 139.50, right? If this was going to be a bull flag, if it was going to truly hold for strength, we should not have come back down into the flag range. We should have supported here for a higher low and then continued to build out new consolidation. Remember the building block principle, right? We should have spent more time up here and not be falling back down into the lower building block. So overall, a little bit more bearish in NVIDIA. I would say that the ultimate rotation would just be to the bottom of the range, closer to 130. So I'd watch for 130 in NVIDIA and see what the reaction is there. I could certainly, just sort of thinking about patterns, right? Could certainly see something like this being reasonable, a little bit of a dead cat bounce off of support, round trip, right? Dead cat bounce. If we put in a lower high, builds the pattern, and we look for lower after that. So NVIDIA no longer as strong as it once was, not advocating for longs there. Next up, we've got Microsoft. What's going on in Softy? Certainly another lower high, more of a look like Google. So high, lower high, closed underneath this level again, 225.80. Strikes me as bearish. Look for downward rotations here. Next up, last but not least, the mini beast, we've got Amazon. And this one's just, ultimately bearish as well. I mean, this just goes right along with the XLY for consumer discretionary breakdown of this sort of daily flag. No dead cat bounce over the hammer highs. I mean, no reason to be going long in Amazon. I'd watch for continued shorts, retests of that level here, put in a lower high up against 88.15. Target on the downside is ultimately 82. No reason for longs. Probably don't short it at this stage in the game. Short into a lower high rally, and then look for something like that with tight risk rewards. So that's the core list of companies. Again, please be mindful that CPI can change any of this analysis in the blink of an eye tomorrow morning, but that's so far a pretty objective interpretation of the charts. Let's take a look at TTD. This chart is interesting from a higher time frame perspective, especially noting what's going on in the macros. Here's the monthly chart. This is an idea that's possibly going to take months to play out. It's just something to consider. It's not really a trade into the end of the week. It's a chart to keep on your radar. So monthly chart looks real bearish. Notice that we've got an overhead supply from right here. We've got a big lower high on the monthly. We've got all of these equal lows. It looks prime and ripe for a breakdown underneath 39.90. All right, think about the macro space. TTD is basically an advertising platform. What is the first thing that companies cut in a recessionary environment? Usually it's marketing and ad spend, right? So if TTD is going to take a haircut from that, certainly would seem logical that a breakdown of this big set of lows, which on the weekly and daily timeframes looks like a big flush point, right? We've had a descending triangle into it in the past. Fake break, we're right back down at the same level. 39.90, right? 39.90. Let's look on the daily time frame, and then we'll continue into the other trade ideas. This is something to have on your radar. Again, I probably wouldn't advocate for big new money shorts here right after earnings, right after big, large red-bodied bars, no big, no dead cat bounce yet. But 39.90 certainly seems interesting, especially noting the macro environment. So TTD, short setup there. Next up is DVN for Devon Energy. What's going on over here? Certainly looks like a flush point to me. Right underneath 66.65, and as we talked about in the energy chart, energy has a flush point as well. You've got a head and shoulders, right? Neckline breakdown there. You've got an H pattern. Anything underneath 66.65, doors open into the 200 SMA, and I especially like this chart because we've got thin structure underneath us. Notice that we've got gap, one singular bar and another gap here. So I'm not saying that we just immediately move to 61.61, but over time, I mean, there's not a whole lot of structural support through that general area. I think the chart will have a relatively easy time moving lower as opposed to just getting caught up in grinding and trying to, push through an area of prior support. So that's DVN on the downside. Next up, and last but not least, is BA. And the only reason that I bring this up is because it's showing extreme relative strength to the market. I know there's been some news about orders that have been pushed through for planes. They've rehashed their budget, or they did something with the financials that looked better than what investors originally expected from earnings. Overall, if this turns into like a bull flag up here, because it's got the most relative strength in the market right now, I would watch for a flag and possibly breakout in Boeing. The reason I'm confident in saying, it's got relative strength, it should be quite obvious just based on, the green bars here, but I've even gone so far as to code up a little bit of a relative strength study, right? This is just BA over SPY. So in a ratio pair, it would look something like Boeing, and then on the bottom, you've got the SPY, right? So overall, Boeing is far outperforming the S&P 500. Again, I hope that should be abundantly obvious with the green-bodied bars here. But again, looking for higher low pullbacks to buy, looks good for upside. And if we just consider a little bit more of the daily time frame chart, a big break of this resistance here takes us up to the next level, closer to 190. All right, so higher low pullbacks are on watch inside of Boeing. It doesn't have to break out tomorrow, the next day, or even going forward, but this is just a longer-term trade idea. So that's going to wrap up tonight's video. Slow-paced, relaxed. Hopefully you enjoyed it. If you did, drop me a comment down below or just give the video a simple thumbs up. Always greatly appreciated. And with that being said, I'll see you tomorrow morning, 8:15 in the live stream to catch the CPI.